What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Chipotle stock. This one has been interesting the last couple of years, and I've traded in and out of the stock. I've made some money in it, but the past year, for the most part, I have not been interested because the valuation looks high, and don't really pay attention to my 5 shares I own here. That's pretty much just so that I could watch the stock better. It's not really a real position, but I definitely am interested in making a position. So, first, let's knock out some news here. Right off the bat, we have the fact with the tariffs going on right now. Chipotle was one of those companies that said, we are going to eat the cost. We are not going to raise prices. Now, they do say if it becomes an out of control problem or whatever, then they could raise prices. And who knows? Just because they say one thing doesn't mean they're actually going to do it. Who knows? But we'll see. Hopefully prices stay the same. Now, the interesting thing is here's what I was talking about. Here's the last 5 years for the price to earnings ratio. And I mean, it's definitely traded up to some ridiculous valuations of over 100 times. But really, you could say that once it got down to about the 50 to 60 level, that's when we've seen some consistency. So it's been 3 years now with it pretty much averaging a P ratio of about a 55 or so, right? Somewhere in there, maybe a 50. But the nice thing is right now, we're looking at a P ratio of about 43, which is really a record low. And, compared to other stocks, I do not want to pay 50, 60, 70 times earnings because all it takes is a little bit of bad news or, their growth slows down or something, and that PE ratio can get cut in half easily. So that PE ratio can drop to a 25 or something real quick. And then you're looking at a problem because then the stock could be falling 50 or 60%. We just saw that happen with Trade Desk the other day. That stock trades it used to trade at, 100 plus times earnings. And the growth wasn't that great. I mean, maybe they grow at 20 or 30%. But then as soon as they have a bad earnings report or some bad news comes out, bam, stock's down 50, 60%. And it's still trading at whatever, 50 times earnings. So it's not like it's really cheap. And so that's the only thing you got to be careful with. You just got to watch out for, a little bit of bad news. The P ratio can get cut in half, and that's really the big problem. I mean, you look at the growth for revenue, it's not that much. 12% this year and then 13% next year. Now, net income is a little bit of a different story. The net income does look a lot better. The last 5 years, we're looking at an average of 35% net income growth, which is remarkable. Those are really good numbers. I mean, you look at what, let's say 7 years ago, they did 170 million in profits. Last year they did 1.5 billion. So the trend is definitely in the right direction. I mean, most people I know, I mean, Chipotle is a pretty popular place. Lots of people like Chipotle. I think they're not going to have a problem there. And the other thing I read here in the earnings report was that they opened up about 119 company-owned restaurants with 95 locations, including a Chipotle lane. So, and right here in Northwest Indiana, I've seen we've already had a couple Chipotles here for a while, but in the last year or so, there's been at least two or three more. So they're like on every street now. So that's probably a good thing because if this becomes, as popular as a Subway or a Dunkin' Donuts or something, and they can maintain a good reputation and some good profit margins and good food, well, then the stock should keep going up. But again, I am always skeptical when I see a stock trading at 60 times earnings or 70 times earnings because it's not easy to that's not easily sustainable. You have to keep up pretty strong numbers for that. Let's see what are we looking at for forward PE right now? We got so this says a forward PE of for this year 38 times, 39 times, which again, based off the last 5 years, that's actually pretty cheap. You're kind of getting a good deal here. And so that's what this is a tough battle for me because it's like there's a lot of things that make me want to buy the stock, and then there's a couple where I'm kind of scared because even though that valuation has come down, all it takes is for some growth to slow or, an E. coli outbreak or whatever. People stop buying their food as much, and then bam, the stock could fall 50% really. So that's kind of what I'm scared of. And I don't know. I'm gonna keep an eye on this one, and we're gonna see what happens. I mean, look at EPS, 1.1 last year to 1.3 expected this year, and then 1.5. The growth is really not that much, right? So let's just fact check this right now. 50 divided by 1.3 is 30. You're paying 38 times, which again, it's not super cheap. Now there are stocks that can maintain that. Look at Costco, for example. Costco Now that's a one of a kind business. I'm not saying this is a Costco, but still, some companies can trade up to 50 times earnings sustainably for years and years. It's possible. And I think Chipotle is in a good position to do that. I'm not saying they can't do that. I think it's very possible. But again, you just have to be willing to accept that risk and just be prepared if a situation like that happens where, the stock goes back down to 30 bucks a share or something, and that valuation, the P ratio comes down. So that's pretty much all I got to say about this one. Let's see what else. How are we looking for? What are we looking at for cash right now? We're looking at, let's see here. Oh, again, they have a lot of capital lease. Cash 1.4 billion. Okay. Shares outstanding is fine. Return on capital 24-25%. That's pretty good. And again, it's an upward trajectory, which is what we like to see here. But I don't know. I think I can picture Chipotle being one of those maintaining one of those popular brands and being like a Dunkin' Donuts or a Starbucks or even a Subway, where they have so many locations, they're on every street, but people still like it. It doesn't, as long as they keep their products good, then there shouldn't be a problem there. But you just got to think you're paying $67 billion. This company is valued at right now, and they only made 1.5 billion. That's it's really not that good. I mean, you look at the free cash flow yield, 2%, right? That's not a very good return, right? That's really not a good return. But I don't know. It is Chipotle. It's an interesting one. I think it's possible this stock could run up the next couple of years and still trade at 55 times earnings, even if their earnings are only growing at 10 or 15% per year. Um, and I mean, when you look at it that way, it's kind of like, okay, is it worth taking on that risk if the company's only growing, I mean, again, they're growing their profits faster. That's the big thing. But if sales are only growing 10 to 15%, that's going to roughly be your ROI. Let's say the stock keeps trading at 50 times earnings, they grow sales at 12% a year or something. That's going to be that's their ROI. And that's just sales though, which again, you have to distinguish between sales and between net income because yes, if the net income is growing way faster and their profits are growing faster than sales, then there's something to be said about that and that's going to justify that P ratio a little bit more. But still, there's just, I don't know. I feel like look at the trajectory of that. Past 5 years, 34% net income growth. Past 2 years, 30% net income growth. And then past year, 24% net income growth. So what are they going to do? 20% net income growth next year, or for this year? So I don't know. You're paying 38 times forward earnings. That's a decent amount. I feel like I'd be really interested if the stock was like 40 bucks. If the stock was 40 bucks, 35 bucks, then I think I'd be a whole lot more I feel a whole lot better about buying. So that's kind of my analysis for this one. Let me know what you guys think down below and I will see you in the next video.